Hi, this is Jessica Morrison, Realtor with Century 21 Sheets. We are back with another mortgage update today, going to learn about some special programs available to you and to your family. With us, we have Rick Planck with Fairway Mortgage. Rick, how are you today?
I'm great. I'm excited to be here. Thank you for having me.
Oh, you're welcome. So, Rick and I actually got connected because I was hosting an open house here in Carmel and stopped by to let me know of an upcoming CE of sorts or a training session on a retirement lending program. And I was very intrigued by the program and thought that it was worth sitting down and just having a longer discussion about, and also sharing with you guys because it sounded like a very helpful program. So, Rick, I've done an interview previously with Fairway. We can spend some time talking about Fairway and those programs again, but I did want to give you plenty of time to talk about what you had shared with me.
Sure. Well, thank you. So, I happen to share, and we happen to find out that you work with Angie Turley here at Fairway, and so I'm part of her team. And so, what I do is I help realtors and builders sell more homes to baby boomers, and I help baby boomers find that retirement home that they've always dreamed of. And so the event that we talked about was a continuing educational event that I'm doing with a builder. A lot of my work has to do with new construction because a lot of baby boomers have saved up and they're ready for that dream home. And right now, new construction seems to be the avenue to go with, but certainly it falls into existing homes as well. And what is unique about our program is that the mortgage payment is completely optional. And that kind of freaks some people out and they don't quite understand what that means. But other than paying taxes and insurance and any HOA, the mortgage payment really is completely optional, which is something great to go into retirement with and not have that burden of a mortgage payment.
Do you know, that's an interesting program. Do you know how that came about, or, just kind of what the discussions were leading up to creating that type of product?
Sure. A lot of people don't understand it's also an FHA program. And so FHA also has seen that there's this large segment of buyers, and what National Association of Realtors has pointed out to many people, the largest group of people buying homes right now is baby boomers. And so it really came about as how do we service that market? How do we help these individuals in their retirement, some who can well afford to write a check and other ones that can't? How do we find an applicable program for them? So the refinance part of this loan had been around for years. The purchase part's only been around since 2008, 2009. It was enacted in late 2008, but the first loan didn't close to 2009. So while that does seem a long time ago in the mortgage sphere of things, it really is a short period of time. So I spend a great deal of my day educating realtors, builders, consumers who had no idea this even existed, that don't have any idea they can move. Oftentimes things have changed in their life, whether it be retirement income or the death of a spouse or something, and they're stuck in place, not understanding that there's a lot of options for them, whether it's a new neighborhood, closer to family. They just don't know that these things exist. So I'm on a mission to work with folks like you and Angie and builders to really educate folks that they don't have to stay in that home that doesn't fit them any longer as they've aged.
Which I think is very helpful because a significant portion of the problems that we're experiencing today with inventory or the amount of homes available for sale are primarily due to sellers overcoming the objection or challenges that occur when they go to move, meaning that they either can't find a home that they want that is at a payment that they can afford, or has as much features and quality maybe that they're either used to or would expect in the cost, and especially with now interest rates being at around 8%, which is just wild. But I was looking at an article last night, and basically like your payments doubled from $1,500 to $3,000 a month just because of how much appreciation has happened, inflation. Inflation isn't factored into your payments, but it's felt certainly in other areas of life. And so I think part of the challenge is, even though we've seen a slight increase in inventory, we still, it can be hard to find homes, especially in that more accessible price point. And so I appreciate that this could be a helpful solution for people who are downsizing, to find something that, especially on the new construction side, would give them peace of mind that, you know, it's got a brand new roof, it's got new HVAC, mechanicals, et cetera, that those big ticket items they wouldn't have to worry about for a long time, or quality hopefully would not be of a concern. So I think there's generally two gut reactions to this rock, and correct me if I'm wrong in that you could be concerned about utilizing this program because there's some concerns about how it could impact the economy. You know, like there's a reason we don't have many programs available where you don't have to make mortgage payments. So there's that thought like, oh my gosh, is this creating a problem? And then on the other end, is this going to create a personal problem for me, or be a bad financial decision in the long run? So I know those are two very loaded questions, but what is your response to that?
Well, you wrapped a lot into that. So just if I go backwards, right? So these programs are designed so that ideally one would never be upside down in a home, right? So the younger that you are, the closer you are to 62, the more money that you need to have down. And the closer you are to, let's say, 100, then the least you don't have to have as much money down, because no one wants you to ever be upside down on a house. The good thing about these loans as well is they're non-recourse notes. So FHA is taking the risk that a client would ever be upside down. So part of your question really had to do with, would someone have liability that might exceed the value of their home, or would their heirs have that? And so that's what I interpreted from your question. And the response is no, because HUD eats that difference. So should there become a point somewhere down the road, someone has lived a long life, there's some financial crisis, and somehow the value of the home went below what they owed, no one's asking them to move out. HUD eats that difference. They continue to live there and still do the same things as they were doing before, paying taxes, insurance, and HOA. So HUD takes all that risk. Should they remain right side up, where the value of the home is here and they only owe this, that difference always remains theirs or their kids. There's no downside. So it's much like a traditional mortgage, except should there be some other financial crisis, HUD's going to be there to eat that difference. And it was something else that you had mentioned, just as an example. I had some clients last year that lived in an older home. I called a 3-story home. And I went to the home. I go to see many of my clients. The bricks had been kind of falling apart, definitely deferred maintenance. They're house rich, cash poor. Part of their motivation for moving was to sell that house because they just couldn't maintain it anymore. The yard was too big. There's too much that needed to be done with that house. They moved from that into a ranch that better fit their lifestyle, a brand new home. Their biggest concern was, what do we do with all of our stuff, which is a logical concern. We accumulated a lot over time. Their financial planner who referred the loan to me was thrilled, as well as the clients, because they took the money they had trapped in their home and they only put half of it down. The other half went to their financial planner to help them for other retirement financial needs, long-term care, those kind of things. So they were in a better position. And they took the trip they always wanted. So they ended up with a better house, low maintenance, a better neighborhood. They got rid of the deferred maintenance, and they were in a much stronger financial position. So that's just some of the things we do with this kind of loan.
Is there a percentage of clients that you work with that frequently work with a financial planner in working with this type of loan?
More and more. A lot of times that is where the referrals come. I'm trying to change that within my role to really focus on builders and realtors as well. But part of the class, in fact, I'm doing a class tomorrow. It is to encourage real estate professionals to talk with financial individuals, because there's a way that we can all change the retirement for our clients. As mentioned earlier, about 80% of the people are house rich and cash poor. They've been working hard because they had to get rid of that damn mortgage, because it's just so bad. And so that's where their wealth is. Well, that doesn't influence the value of one's home. The value of your home doesn't go up or down depending on how much you owe on it. And so equity has no rate of return, but now it's trapped. So we're working with financial planners to free it up, like in this earlier case. So people have money to live on, they have money to give, they can buy that home they've always dreamed of. So financial planners are a big referral of this. and I'm trying to encourage real estate agents to talk with their clients or with financial advisors, because there's a way collectively we can change retirement.
Sure. Now, is it possible if you have, let's say you have a senior citizen who is already in a good home, but like you said, is house rich, cash poor, would they be eligible to potentially do a refinance or obtain that type of loan so that they can have access to cash and therefore improve their quality of life because the home is worth so much more? And if so, or if not, what would be the drawbacks for that?
So it's a good question. So what we talk about in our world is there are three buckets. There's the bucket number one, which is income. And typically, you know, when you're working, you've got larger income. When you retire, that bucket seems to go down, right? Whether it's just pensions, living off other assets, or Social Security. Then bucket number two is financial assets. And then bucket number three is the home. And so what happens, as we mentioned, is that so many people put more money into bucket number three, the home, than they have in bucket number two. And so they quickly run out of money, but now they have this other asset, bucket number three. So with these kind of loans, if you think about it as nothing more than a spigot that people are putting onto their bucket, their home value, and they can turn that on and off how they need to, and they can access those funds for whatever they need to. Whether they want to turn it on a little bit and they want to take distributions to themselves each month, great. If they need a splash, so to speak, they want to give money away, they've got some other needs, then they just turn it on. As long as there's water, you know, equity in that bucket, they can turn it on and use it however they want. And that's all this type of loan does, is just give them access to what was already theirs to begin with. And especially if they want to give it to their kids now, it's kind of a crass term, but sometimes we'll say it's better to give with a warm hand than a cold hand. Well, why not use that money now to make your kids or put your kids in a better situation? Or oftentimes it's the grandkids. We joke about how often the grandkids are loved more than the kids and they're spoiled. So why not do that now and be able to enjoy that and be able to see it, whether it's college funding, whether it's trips, whether it's even helping their adult children buy a better home now and give them that larger down payment in this kind of crazy market. Why not do that while they're alive rather than wait until they pass?
Yeah, that was something that I think was a very unique solution when you first proposed that to me, was seeing the thought process of, oh, you know, we as parents have accumulated wealth and equity, we're going to pass that on to our children when we die and let that be a nice inheritance to them. And I don't think that's a bad idea, but I thought it was certainly an interesting solution to, you know, if circumstances are right and it makes financial sense with talking with a financial planner, potentially doing a loan like this with that thought process of, hey, you know, let's set you up on a path, son or daughter, to build wealth. And, you know, it doesn't have to be a crazy amount of money, but, you know, if that, you know, especially if you ran with, like, if you had the child sit down with a financial planner and do the math and the cost of waiting and, or talking to a realtor and, you know, saying, hey, if we got $30,000, what would that do in the next 36 months with our finances? And how much wealth and equity would we have by being able to own a property rather than pay rent and pay 100%? That's kind of the joke right now, rather than 8%, or potentially get a much more affordable loan. So,
well, to your point, the best time for someone to give the money to their kids and their grandkids would be now. Now, we certainly are not going to advocate that they die. That's just crass. I mean, that's, you know, so we want everyone to live a long time. So why wait, you know, another 20, 30 years and wait for that inheritance when they can use and engage that money now? And to your point, what about if they invested it now? What about if they put that into the home? You know, the home that their grandkids will be in and their adult children. Why not give that to them now? So this is one option to do that, in addition to buying homes. But yeah, it's a powerful tool, and more people are waking up to it.
So what would you say is, like, out of the loans that are being serviced right now, obviously this is FHA government backed. What percentage, if you had to take a guess, of loans that are being originated right now, are of this type? And do you think there's any long-term risk with having a larger portfolio of loans where people haven't been paying? And we certainly believe that homes will continue to appreciate. And so obviously you're going to be being strategic with who you issue approval to for this type of product. But I guess, do you see any long-term risks or negative impacts with the housing market because people aren't paying on their mortgage from this?
No, so to go back to the original part of this, the younger that someone is, the more equity that they need. So there's the hedge and the risk, and that amount changes with the market. So when we have the higher rate environment that we are in now, then they need a little bit more. So there's already those safety guards, the safeguards in place to kind of help mediate that, because HUD doesn't want to eat that difference.
Right.
And so they're not dumb about that. So there's already that circuit breaker in there, if you will. So that's part of that question. And then what does happen in these markets, as we're well aware of, in these inflationary times, while maybe the appreciation of homes is not quite skyrocketing as it was, you'll still see there's a steady growth of appreciation overall. When interest rates do come back down, there's going to be appreciation as well. I mean, we'll continue to see that. And so it's not as if we're, especially here in Indiana, we don't have those volatile swings. So I think from that standpoint, it's pretty safe. And again, HUD monitors that. From their perspective, these are well-capitalized loans. They have mortgage insurance that they collect on these to help safeguard that. And it's profitable from that standpoint. So it's not the high-risk subprime loans that were done in 20 years ago. They're pretty much monitored.
Yeah, basically the nutshell is we learned from 2008.
Correct. And so the earlier version of these loans, there was not the financial assessment that is involved today. So while someone doesn't have a mortgage payment and we don't look at credit scores or debt to income ratio, there's still a financial assessment, because we want to make sure, again, that we're not putting someone into a situation that's going to be bad for them. So we still want to make sure that they can pay for these things. It doesn't necessarily always mean they have to have a job. I've done these loans. I did one loan for someone that had no job, but what he did have was he had a bunch of financial assets. And so logic says, well, he's got the money to pay the bills, and that's what he did. But since, for about 15 years or so, there now has been that financial assessment, once again, to make sure people are not in a bad situation.
That makes sense.
Yeah, and something else that you mentioned earlier, I just wanted to reflect on. So what does happen as well is individuals with the price, as we're talking about home prices, there are folks that don't realize they can move because, like in an example that I use in some of my classes, let's say that John has lost his spouse, and so he's got a $2,000 mortgage, but now his income has changed. And so he's now in a house that doesn't fit him, in a neighborhood that he doesn't enjoy anymore, and he has a mortgage payment with less income. So if he were to net around $250,000 from the sale of that house, most agents would only show him a $250,000 house. But this loan has such purchasing power. What it does do is now we can show John a $400,000 home where he would still not have a mortgage payment. He's going to be in a nicer neighborhood, perhaps closer to his kids, right? And actually he'll create more wealth because that $400,000 home will appreciate more. So now we've greatly expanded the type of homes that he can look at. And when he makes that move, the home that he did live in is probably an ideal home for a first-time home buyer, right? It's probably a 2-story, all big yard and those kind of things. It doesn't fit his lifestyle anymore. It's going to fit someone else's, and he's moved and he's transitioned. So we're seeing a lot of that, and we have a lot of agents that are going to older neighborhoods, naturally occurring residential communities is what we call them. People have been there for a long time, but their lifestyle has changed. And so it's kind of cool that as this program takes off, how we're helping to transition those neighborhoods too.
Yeah, that makes a lot of sense. I know you just gave an example, but I really want to flesh this out for an example purpose. So maybe let's talk about the most common type of buyer that you work with, home value. Let's just kind of give an example scenario and what the numbers look like for what somebody could expect.
Yeah. So what would you give me a little bit more numbers and I'll.
Let's say the house is worth 250 and it's somebody who's looking to potentially get into there's sorry, my creative brain just thought of 3 scenarios out of this.
Right.
So let's just say that the house no longer fits their lifestyle. It's worth about 250. And they're looking at the market. There's not a lot of homes that interest them. What are their options?
So depending on their age, so in the example that I use, let's say that client was 70 years old, John, in this example. So if he nets somewhere around 250, 254, that's what it's going to take for him to buy that $400,000 house, down payment, closing costs, I factored in something for insurance. For the same amount of money pocket, for what he's going to clear on that house, that's what I'm assuming that it would take for him to get into the new house. Does that help answer your question?
Okay. So you would take the 250 or any net proceeds from the sale of a property, throw that in its entirety to the new home, assuming that would work for a $400,000 house and they would have no mortgage payments.
Correct. They're still responsible for taxes, insurance, and HOA. And so that goes back to that financial assessment that we do. We want to make sure that they can still handle that, that cash flow, that they've got enough money left over to live on and, have a Netflix subscription, whatever it may be. So, but yeah, we don't want to put them in a bad situation.
So, and I'm sorry if you guys are watching this and you get it. I'm just being exhaustive because I know for me, numbers are hard to follow in my head, but Rock, for an example purpose, do you have a comparison numbers wise of what that payment would be as a mortgage versus just paying for taxes, insurance, and HOAs? And I know that HOA and all that's going to be kind of relative, but just for your standard 400.
Hold on a second. So, we're just kind of winging this a little bit. So then, because I have a PowerPoint up that I've done. So just to give you an idea, one of the examples I use in the classes I teach is Alice. And Alice is going to buy a $600,000 home. Well, she could write, a larger down payment. If she puts 20% down, I did this when the interest rates were closer to 7.25%, that mortgage payment that she would have would be around $3,280 a month. And so now she's got that mortgage payment. And she's going to have that for 30 years. That's $1.3 million in cash flow that she's going to have in her retirement. All right. So, or she could pay $600,000 for the house, and have no mortgage payment, or she could put down $386,000 and still have money left over and have no mortgage payment. So to answer your question, in that case, if she just puts down 20% to avoid mortgage insurance, she's got a $3,300 house payment. Why have that in your retirement if you don't have to have it? That's money that could be put elsewhere. That's a big burden on your cash flow.
And do you know by 3,300 what it would be without it being a mortgage payment on that example? Like what it goes to?
Say that again.
So you mentioned the mortgage payment would be 3,300. By removing principal and interest from the equation, what would that monthly expense roughly look like?
Yeah, it would just depend on the house. I don't know what the insurance will be. You've got $500 a month probably for taxes, 1%, let's say another, $100, $150 for insurance. So, now you're $650, $700. So, throw in some HOA, so probably your $800, $900 a month, which they're going to have regardless, right? Whether they have a mortgage, they have no mortgage, or they have the retirement mortgage, they're still going to have that $900 example in here. But that's much more manageable than a $3,300 payment.
Right. And that's roughly working on a $600,000 price point. So just using this for those watching as an example to kind of help you. Is it fair to say that it might be about a third of the payment?
As far as what their escrows would be?
Yes, in that,
Yeah,
you
it's
know,
just going to
by,
depend on the property. And
okay,
again, yeah, however they want to pay those, they're treating it as cash. So we're not collecting that payment. There
right,
are ways that we could do that.
okay,
But this is just something that they're going to pay for. So part of what happens in our process is whether the client is someone that um, is a little more struggling on one end and we're helping out, or they can, a lot of our clients can write checks. Doesn't matter anywhere in that linear example. We still require them to go through FHA counseling to say, hey, as a reminder, you need to budget for this. Have you
yep,
thought about this? Do you have to do that? That's part of the requirements for these loans. Kind of wish we did it on first-time home buyers.
yeah.
But hey, do you know that stuff might break in your house? You need to be prepared for that. You need to have a little fun for that.
Yeah, and we try, I mean, there's a lot of angles to cover in real estate, and I would say we as realtors are responsible for a lot, and I think the more education, the better, especially for multiple angles. Just, I think it's sometimes just helpful to hear things from a third party. I'm not looking to necessarily shirk responsibility, but I just think sometimes it's helpful to hear people say, even if it's the same thing, it could be a different flavor, so to speak, and it's going to resonate with people differently. But I think always going above and beyond in communication to educate and empower people is really important. So, and I agree with you on the first time home buyer aspect. I think that would be very beneficial.
Well, but to your point, before you move on, that's why I love this particular program. They're family loans, they're trusted advisor loans. And what I mean by that is often the family, who are usually adult children, are involved in this. The financial planners involved in it. Real estate professionals are involved in it. And so sometimes it makes sense in my head, but when it comes out my mouth, maybe not so much. And then there's someone like you that we've been able to work with a little bit and say, well, you can put it in a different language for them. It's the same thing that I said. It's just you said it in a different way. And it's like, oh, that's it. So I love other people being involved in it because we might as well all have that conversation so everyone knows what's going on. But sometimes they're able to break down that communication wall a little bit better. So I love it.
Sure. So to kind of close this out, we've got a few minutes left here. What would you say, I mean, as people are navigating the market today, and you can speak directly into what we're talking about, or just in general, we're coming into an election day next month and winter. What are your thoughts on the market right now? And maybe what tips do you have for buyers and sellers who are trying to navigate things?
Well, certainly as it relates to this loan for the baby boomers, I think I would approach things with an open mind. These things have been vetted, whether it's Texas Tech, whether it's some very well-known financial people within the industry. These loans, literally, if you could see my wall, I've got 4 different books that are like this thick. These loans and how they're used have just been vetted and tested and so forth. There's such analysis on it that said this is something that we should all be considering in our retirement. In regards to the market, I think it's going to be interesting, and it'd be interesting Christmas season. And I do think that there's going to be some numbers that come out. In fact, we've got a big call with strategists, a company call that actually is going on right now, really to talk about the market. But I think it's going to be interesting to see what happens. Certainly the Fed is trying to do what they can to slow down the economy. Christmas season is going to be interesting. How much money do people really spend? My guess, and again, I'm just a nobody, is I think Christmas will be a tougher season than most people expect. And I think that will help our rates when we go into 2024.
Well, and then you've got consumer credit card spending. I don't know if I can say it's at an all-time high, but I know it's certainly risen consecutively each year, understandably. And I think the thing that I appreciate the most about this is I have a big heart for the elderly, underserved communities, like the voiceless, just because I think those people are frequently marginalized or taken advantage of. And my mama bear really comes out to advocate for them. And the thing that I am very hopeful about in a product like this is Or I think generally when you hear the term reverse mortgage, there's a lot of, pullback and rightful hesitation. The thing that I think gives me the biggest peace of mind is that there's a lot of, if you do it right, which I think in working with somebody like you, Rock, you're going to be passionate about educating, about bringing in multiple groups of people, like a financial planner or a realtor, and just kind of having a personal board of directors to speak into the situation and advise, and where their professional expertise is London. And you could even talk to a real estate attorney too, or an estate planner, and just really not only plan your future, but the thing that makes me really excited and hopeful is, just helping people enjoy their quality of life, especially when it's near the end of their life. And then being able to bless families and help that next generation that's coming up get into home ownership potentially, or maybe not have the burden of student loans anymore. So with about a minute left, Rock, is there anything else that you'd like to add, or what's the best way to get in touch with you?
The best way to get in touch with me, you can just even go to my website, reverserock.com. That's probably the easiest. So if you don't have to remember numbers, just go to reverserock.com. We mentioned earlier that Angie Turley. So if you're already an Angie Turley client or referral source, you can always get a hold of me through Angie. As well as if you are working with someone else at Fairway, I'm the guy here. So they'll, one way or the other, they will get a hold of me there. And so to your point earlier, or just a few minutes ago, a few seconds ago, it's really cool that there are some really fun, geeky financial strategies that we use with people of high net worth in this type of financing. And then you do have those that perhaps too often it's the course of the last resort. And those are kind of fun sometimes. Sometimes they're sad too. But I recently helped someone that has MS, help her pay off her mortgage, pay off her disability van, as she called it, the payment on that. And then she was taking out enough money to then pay for home health care. It was about a $1,500 a month swing to then have home health care aides come in to help her throughout her day, and just the change that it had on her. I mean, I like calling her up sometimes because she's just funny, and it's just, you get that sense of joy just on those little things. So I get cookies from some of my clients too. And it's like, you've had an impact when they're baking you cookies. And most of the time they're pretty good. Not always, but most of the time they're pretty good. I'm appreciative either way though.
No, that's wonderful. And I think, especially being somebody who has had to overcome a severe medical condition, drastically impacting your quality of life, when you do have that burden lifted, and that can look like a variety of different things, but when your quality of life improves and when that stress is no longer on the table, it's hard to prove scientifically, but stress comes in a variety of different formats. And especially if you are battling a health condition that's not helping you. So I'm very, very excited for you and for your clients.
Yeah. Well, and even if it's just for that moment that that on that day or for that period of time or whatever, you've had that impact, it's geeky, I admit it, but then you get to feel good. You might have something else where your puppy had a little accident on the carpet or whatever, and you're like, crap, but my day is still so good because I was able to help this person. Yeah, it's fun. It's sometimes it's selfish. You're like, look what I did. I impacted someone's life. So I think that's all right to feel like that sometimes.
Yeah, now we're getting into philosophy with ethics around altruism. Is it for you or is it for them? And I think that's a really good thing to leave on, and that, we're coming into the giving and the holiday season. And so for those of you who are interested in working with Rock and Angie Turley's team at Fairway Mortgage, I'll have the information here in the description of this video, and feel free to connect with them if you have any questions, or if you need a comparative market analysis on your current home, or just would like a market update. I'm happy to provide that data to you, and there's no obligation to work together, but just love providing accurate and relevant resources. Believe it or not, the news anchors don't always get the data right, or if you hear national real estate data, that's not always relevant to your specific market, because that's taking things like San Francisco and Miami and Chicago and putting it all in one bucket. And all of those are going to have different nuances. You know, Indianapolis is not San Francisco. And so it is nice to see on a holistic level the trends and where we're heading, generally speaking. But I just think, you know, if you're in a different state, you know, I do have relationships with agents that I trust to send referral business to. So just know that we have resources available. We're passionate about educating. And Rock, thank you so much for your time today.
Thank you. I love what you're doing here. It's certainly not what the rest of the group is doing, and you've set yourself apart. So it's really cool to see.
Well, thank you. It's definitely out of my comfort zone, for sure. But at the same time, if you don't, you can listen to the voice of fear and the critics and what you think might be said or people judging you. But something that I find to be very empowering is someone who's doing more than you is never going to criticize. Like if there's critical feedback that's helpful, they're going to do it in a way that empowers you. And those who are going to throw stones are not at the same level, or that says more about them than it does about you. And so I just, again, have that heart of educating and hope it's helpful. So if you guys did find this video helpful, please share it. But yeah, thank you for the compliment.
Thank you.
All right, guys, have a good day. How do I stop?